Hey guys, so this week I'm doing something a little bit special as sort of like a bonus video on my channel. This is a weekly video I do within the Obsidian Council that's typically exclusive to people that are a part of the Obsidian Council. But I wanted to share it this week with you guys because it really hits on a lot of the things that people are asking right now in terms of if this massive liquidation event we just went through really shifts things and what the current macro data is pointing to for Q4 and beyond. Welcome to the Obsidian Council weekly market update. Today we're going to be diving into the liquidation event from last week and some of the price action that's followed since. Like we had kind of like a decent run up and now we've had a little bit of a retracement. What does it mean? What does all of this spell out for like the rest of October and November, especially now that you kind of have some of these 4-year cycle believers rotating out? Like, is that sell pressure going to offset any potential run up into Q4? We're going to dive a little bit into some other big macro voices who are now pivoting and agreeing with what I've been saying for forever, that this cycle is going to go well into 2026, not just into Q2, but beyond at a minimum into late 2026, possibly even further than that. And finally, we're going to dive a little bit into virus and why I think I undersold exactly what's happening with their buybacks and what it's going to mean for the future price of that token. Taking a quick look at prices, we have Bitcoin at 112K, ETH at 4,100. Obviously, last week we had a major liquidation event where the price of Bitcoin went from a high of 126K all the way down to a low on the wick of 105K. I made a YouTube video going into details about the dynamics that caused this. Obviously, we came right back up and since have kind of recovered, coming up to a high of 116, but then dropping back down to 110 and kind of retesting that, sort of bottom outside the wick and then kind of bouncing up again. Obviously, there's a lot of people that are concerned because they thought this would be more of a V-shaped recovery. We hit this and we just go straight back up. I don't think there was people are saying that on X. There wasn't like any reason that it had to be a V-shaped recovery or not. I'm more under the belief that this liquidation event definitely had the potential to like kind of activate the 4-year cycle rotation, and that there's just like the slow bleed of people who believe in the 4-year cycle just kind of rotating out of the market, which seems to be the case, especially if you just look at sentiment on X. You're seeing a lot of people saying, hey, it's the top, I'm out, etc. And so I think we've hit this sort of, not only do we have still the kind of overall liquidity weakness in the market, but now we have this sell pressure coming from people exiting because of their belief in the 4-year cycle. And that's kind of keeping prices suppressed. Could that turn around as like maybe liquidity strengthens in the second half of October? Yeah, like it definitely could. And this is actually a question that Astronaut asked in the Discord where he said, so regardless of if we hit peak all season late 2026 or if it extends into 2027, we're still looking at a typical end of the year bull run here into 2025, correct? Not on alt season levels, but a nice run up. And my response, I put out kind of a bigger response to this, basically talking about how, my initial belief was that absolutely we were going to have an end of the year kind of run up, but I wouldn't say it's in the bag. Right now, because of specific plumbing issues in macro, plus the fact that you have a huge swath of traders who believe the cycle is over, you have a really unique setup where you have this huge group of people ready to sell because of the 4-year cycle, and you don't know exactly when or how they're going to sell. Obviously, it's not going to all happen at the same time, but certainly this liquidation event triggered some of them to start selling. And then, we had this kind of recovery, but now that we're kind of, slumping again, you're having more of them saying, oh, this is, maybe this is over. It's time to exit. And so I don't know if you're just going to have this continual slow bleed going into, through November, and maybe that kind of just keeps prices suppressed. Like that's a possibility. Or maybe it turns around with seasonality. My original belief was that, hey, like you have end of the year seasonality. It's typically bullish. A lot of people believe there's going to be a blow off top. So like sentiment and everything kind of aligned to having a big run up into the end of the year. But people didn't expect the first half of October to be as weak as it was. They certainly didn't expect this major liquidation event. And I think you got to just kind of roll with the punches as things change. And, this has certainly changed the setup a little bit where kind of think of it as like a big bat signal for those sellers to say, hey, your time might be here. And because of that uncertainty, you're definitely going to see people rotating out. Now, I don't think this is important as some people want to believe it is. Like, everyone in crypto, at least the 4-year cycle believers, are like stuck in the past of how things were. And I posted this chart on X, and sorry, it's a little bit blurry, but it shows past cycles and how they were driven primarily by retail FOMO. So it's like they're sporadic, they're crazy, and they're these like kind of parabolic run-ups. So it's like 2013, you have 2017, you have 2021. And then it shows the current cycle, which is more of this structured bid. And I've shown this chart like a million times before. But it does show how this cycle is very different than past cycles. And actually, I think it'd be like almost flat if you didn't have the structured bid from flows that comes from ETFs and institutional adoption. Now, this doesn't necessarily mean it's institutions buying. A lot of this buying is actually boomer money. It's my belief from the primary buyers of ETFs are retail. I don't see why people that are in crypto would be those buyers, except for like in rare circumstances. But it does make a lot of sense that boomers are, especially because everyone, all these experts are going to CNBC, which is like their primary source of truth, and saying, hey, like this is the future, you need to own some, et cetera. It makes sense that they'd be allocating in via their financial advisors, et cetera. And so that's kind of been that primary bid of what's been moving us up. And again, if we didn't have that, if we didn't have the ETFs, I think we'd be flat or down. Or maybe it'd be like kind of up because it's loosely following AI and the build out in the stock market. But it certainly wouldn't like be anywhere close to where we're at. And this is what a lot of people are missing in the current picture, is that the primary driver of the stock market right now is AI. Maybe a little bit of robotics, but like primarily it's just AI. Like the top 7 companies or whatever make up the vast majority of the gains in the stock market right now. And all of that is narrative driven by AI. Like just people believe that this is going to be transformative. They're probably almost certainly right. Like AI will be transformative. It's more about like when than if. Like, is it going to be a short-term thing, or is it going to be like, the internet just took a long time for that to unfold? But the stock market gains and crypto gains have not been driven by underlying like structural bursts in liquidity. That's the difference between this cycle and previous cycles. Stock market's been driven by speculation around AI. Although I think that's different than past cycles like the dot-com bubble, et cetera, or like the railroad bubble from way back in the day. And that's because I think this one's going to actually yield fruit, like direct fruit. Now, I had somebody like on a podcast, I think it was All In Podcast, and they were talking about how like during the dot-com bubble, you had all this build out of broadband. And, it was too much build out and they didn't use it. And it took like, 20 years to kind of to catch up to that. The big difference here with AI is like you have all this build out of like data centers and energy build out that's coming, but it's being used. Like we don't have an abundance of it. We still have a vast lack of it. We could use a lot more of it. So that is kind of a major difference between those two things. Now, my overall point is you can identify the drivers of each of these markets. One is AI build out. One is institutional structured bid. Remember, crypto is just really, really small. It's smaller than NVIDIA, one single company. And so it just doesn't take a lot to move the needle in terms of things. And so it's not an underlying easing cycle that's driven things up. Where 2013, 2017, 2021 were easing cycles. This was liquidity in the macro picture. We're pushing things up, not the same forces that are pushing things up right now. In fact, we've been in a tightening cycle, which is why things have been so hard. And we're just now starting to head into an easing cycle, which is where you've seen these previous gains, which tells you that easing cycle coupled with flows, it's likely to be a pretty insane run up in terms of like where we go into 2026. And this is what a lot of people are missing, right? The picture they're missing right now. So that's my thesis. And I talk about that thesis all the time. But as people are like looking at this chart, they're like, oh my gosh, it's the end of the world, whatever. But I will point out these people are never right. Like we went through the same thing in the April tariff sell-off. That lasted a long time. Remember, that was like December through like whatever, May. That was like half a year. Okay. And it was rough. But the sentiment's just peaked right now in terms of like everyone thinking this is the end because of the 4-year cycle. So there's just this really strong narrative around it. But these people are still wrong. Like they're following an outdated model. I'm going to put out a video where I actually break down 2013, 2017, and 2021 and kind of the causes behind those cycles to make it really crystal clear. That should come out soonish. Basically, there's no reason for us to have topped. is what I'm saying. There's absolutely no fundamental reason for us to top where every other cycle has had a reason. We went from easing into tightening. And so there was like a really strong concrete reason of like, oh, we've topped because the conditions are heading like in the opposite direction that we want them to. And in this case, the conditions are heading in the direction we want them to. The only reason people say we topped is because the 4-year cycle. It's like just literally like, oh, it's been X amount of days since the halving, so we've topped. Which for me just isn't. That's not a good reason. But obviously, as I say all the time, I am no wizard. I don't know how October, November, December are going to for sure play out. There is a lot of guesswork here of like, how does this dynamic of people believing the 4-year cycle selling clash with like, liquidity slowly improving into December? Do those things cancel each other out? Do we go sideways? Like, I don't know exactly, but I'm not going to sell. I'm not going to get shaken out by this. I'm holding into 2026, and I'm like leaning heavily on my thesis because that's what makes sense to me. Taking a look at global M2, you can see we've kind of stopped our decline and started heading higher, which is exactly what we want to see. And just kind of further accent my point, you can see we have not been in an easing cycle like these previous run-ups. We've actually been in like a desert. This is what like intense tightening looks like. And we're just now starting to see, some form of like decent liquidity hitting the global market. Looking at trueflation, we're kind of just heading sideways. Again, we kind of don't want to go over this area, right? Like you can see each time we get here, we seem to get rejected. We don't want to see inflation break out in any meaningful way. We're going to keep tracking it. If we're heading sideways or lower, that's fine. Honestly, if we do peak up a little bit, I'm not going to be like, I guess, super concerned. This is back in 2024. We went all the way up to 3%. And we were fine. Like we came back down and we were good. I actually think the end result of like the policy decisions once Jerome Powell's out is that we probably do run up to about 3%. And we drop rates below that. At least I'm basing this primarily off of like post-war, like what do governments do? How do they inflate away the debt? That's how they do it. They let inflation run a little bit hot. They drop rates below that. And then that it allows the economy to like run full steam while they're inflating away the debt. And for them, they just don't care. Like the inflation's running hot, sure, but that's their way of getting themselves out of debt. Taking a look at the liquidation heat map, it's looking pretty good in terms of the downside. Typically, you see like a big bright yellow area. That's like a cluster of liquidity the price likes to go and hit. At least right now, the brighter area is above, which is a good thing, at least looking at this model. If you zoom out a little bit, you can see by and far the brightest levels up here around 116K. And the more people believe in the 4-year cycle, the more you are going to see liquidity pile to the top side. The more people are believing, hey, we're going to go lower, the more they're likely to short and stack up here, which provides the opportunity of a run up into higher prices, which kind of shows you like exactly why we're not going to have a market class. Because if you look at past cycles as well, I've highlighted this before, like every time, like the height of 2021, everyone was saying like, we're going higher. Everyone was yelling buy the dip. Like people weren't like scared out of their minds like they are right now. And because of that, every single time that we maybe broke through lower, people would just deploy more liquidity and go long, and they would just do it over and over and over and over again. You're not seeing that. Like obviously there's some people that are deploying liquidity, but you can see it's much sparser to the downside than the upside. And by and far, the sentiment overall is more bearish than it is bullish. Now, earlier this morning, I was listening to a podcast with Raoul Pal. If you guys remember, I don't know, like a month ago, somewhere around there was like a podcast or something came out with him where he talked about how he saw the cycle extending into Q2. I disagreed with that. I talked about how I see it going into late 2026 at the earliest, and possibly even beyond that. Like just based on the macro setup, that's where it seemed things were going. But as soon as he came out and said Q2, it's like everyone and their mom was like, "Oh, I see the cycle going to Q2," and and all these influencers and KOLs were like, "Yes, here's my thesis on why it's going to Q2." And it's like, dude, obviously you guys are just copying what he said if it's coming out like within 24 hours of him posting it. But what I said was, I thought given time, they were going to come to the same conclusion because it's obvious that the cycle is going to go well beyond Q2. And I was listening to a podcast with him this morning where he said just that. He asked Andreas how long he saw the cycle going. And he said, for now, it's accumulation zone and will remain the case for a couple quarters. And then we'll have to see during 2026. But I actually wouldn't be surprised if the cycle was still alive a year from now. And then Raul says, yeah, and my probabilities are going that it might be a year from now, maybe even longer. From what I see, the structure of everything, the forward-looking leads that we've got, like our financial condition index, leads by 9 months. All of this just suggests that it's going to be a lot longer than expected. So there you have it. More people are jumping on the train that this cycle is going to go a lot longer than people expect, as I've been saying for forever. I was one of the very first people to say it. This is going to be the first 5-year cycle. And at the earliest, I see this going into like July through October 2026. But I'm very open to the possibility of it going to 2027, 2028. Like, I don't know exactly. It depends on policy decisions and like how much they get boosted. But I lean far more towards like that being possible than us ending right here today. Another thing I want to highlight is Addicted Season 2 is about to drop. What they've mentioned is that it's going to have the biggest prize pot in crypto history. And one thing I put out in a recent video that a lot of people didn't seem to catch, but it's kind of insane, and you probably should catch it, is that I'm going to say this again and make it clear. They said we're kicking off 780,000 in strategic buybacks using 25% of all addicted fund revenue, meaning it could be a lot more than this. Okay, this was as of the moment of this posting. The first 70,000 in buybacks have been executed. Now, a lot of people misread this and thought that they said that all $780,000 worth of buybacks were done, but it was only 70,000, meaning out of the 780,000, they still have $710,000 worth of strategic buybacks left at minimum to buy back the virus token. That means there is $780,000 or $710,000 worth of buys coming at some point in the future, and you have the opportunity to front run that. And to show you what I mean, I believe when they did buybacks last time, and consider the volume was huge, and I'll explain why that matters in a minute. The market cap was sitting around 8 million, and the buybacks pushed price all the way to 12 million in market cap. Okay, so the $70,000 worth of buybacks pushed price from 8 million to 12 million in market cap. Now, at the time, there was a decent amount of volume. Like basically from here, when the Addicted launch went off, like a ton of volume came into the token. And during this kind of whole downfall, like it was lowering, it was going down, but there's still a decent amount of volume running into this sell-off, right? Like this is kind of in the middle of the entire price deflating. And so you had a lot of sellers that used that run-up as sort of exit liquidity. Since then, volume has died down quite a bit. We're sitting at just 104K worth of volume, meaning that big buys have the potential to move the price a lot more because a lot of those people who are rotating out have already exited. And so you're not going to have as much sell pressure going into it. So if the price, if this was able to move the price from 8 million to 12 million, and essentially at minimum, the amount of buybacks that they have moving forward still left to do is 10 times this amount. Okay, so if it moved from here to here, you're talking 10 times that amount. That could meaningfully impact price. And again, that's at minimum. Like if they make a lot more during season 2, since that post, like however much they've made as well, that could have a pretty massive impact on price. And just the idea that like, hey, you're going to have this massive buyer you know is coming in to push up the price. Why wouldn't you buy before that? So that's one thing I felt like maybe I didn't hit the nuance on my video as well as I should have. And although I have not talked about airdrops in forever, I do think it's worth highlighting the Monad airdrop because so many people qualified. It's just at least worth checking. Always be careful because whenever big airdrops like this come out, there's like a ton of scams and you got to be really careful with links. I do not trust any links. Like always go to the source and then like check it like 10 times. Okay. You be smart about this. But if you use Hyperliquid, Phantom, in some cases, Pump.fund traders, longtime holders of NFTs, like there's a whole swath of people that qualify for this airdrop. So it's worth at least checking to see if you qualify. In the OC, I'll post a link, but again, even me posting a link, just always triple check it. As always, none of this is investment advice. None of this is me telling you to do anything with your money. I'm obviously not your financial advisor, and you should always do your own research. That's it, and I'll see you guys next week.